Today I want to talk about distressed hedge funds. What are distressed debt hedge funds? Normally what happens is when private equity enters a company, they load the company with lot of debt so that they can use their cash flow, grow faster and declare bigger dividends. And as they fatten the cow, they would like to sell it. But this strategy is a brilliant strategy. But at times when recession hits, and especially when they are blindsided, this can be a major problem. And because there is a lot of debt, these companies are struggling, are near sinking. There is a group of hedge funds known as distress hedge funds, which look for situations like this and buy nearly bankrupt companies. That is, they buy their debt, the equity is reduced to zero, you buy the debt, you take control of the company and then you turn it around. They buy distressed debt at very cheap rates. They buy a $10 debt at $2, $3 and at sometimes $5, $6 and then they wait for credit cycle to turn around and they sell for huge profits. Why am I talking about this? Because I saw this playing out right in front of my eyes in this year in India. Because I talk too much of debt market and I watched this cycle when debt sunk to almost very low levels and then shot up. I am talking about IndusInd Bank. IndusInd Bank was down and out for the count. There was some doubt that the owners will not be able to put out money and the stock price dropped. And it dropped by a huge margin. A stock which was trading in a north of 1,500 rupees had dropped to 350 rupees. The Hindujas who had 15% stake in the bank wrote repeatedly to the Reserve Bank to allow them to raise the stake to 26%. And they were willing to buy the stock at that price. The Reserve Bank did not agree. At the same time, the long-term manager Ramesh Shodbi had to retire because he turned the age of 70 and had to mandatorily retire. And the new manager, who was the deputy managing director before, Sumant, had to take over. The market got very nervous, and especially because there were two reasons. One, IndusInd Bank was a heavy financier of commercial vehicles because the group's sister company, Ashok Leyland, it was a major financier of Ashok Leyland trucks. Also, it had taken over the old SKS Micro and there was likely a lot of micro debt. What IndusInd Bank needed was capital and lot of capital quickly. The price stabilized when an American-based hedge fund manager, Root Capital, put in 9% of the company at the prices that were trading at that point of time. The owners also could increase their stakeholding sequentially and they also put in some money. This stabilized the price and the price went up higher. Sometime later, the promoters exercised their right to buy some shares at a price far higher than what was trading in the market. And then even that money was raised. So nearly 5 to 6,000 crores was raised by IndusInd Bank as equity. The prices stabilized and from a low of 350, prices doubled and went above 1,000 rupees. But I am not here talking about how the prices moved. As the crisis ebbed and flowed and there were talks of a forced shotgun merger with a larger Indian private sector bank, how the bonds of IndusInd Bank moved was very impressive to me. The 100 rupee bond at one time dropped to 72 as nervous bondholders were ready to dump after their experience with Yes Bank. But I held my nerve, we bought some more, we already had some bonds. But once we knew that the promoter was having a huge amount of money and would bail out the bank, it was a no-brainer to hold on to it. I knew of a jeweler in Mumbai who bought nearly 50 crores of bonds when the IndusInd Bank was its lowest. The bonds have since rebounded and gone to 103, 104 rupees. But the bond which paid 10 rupees interest every year dropped to 72 rupees. That means the return went to 17 or 18%. This is what Warren Buffett means, that you buy when there is blood on the street. And once we knew very clearly about this, I kept discussing IndusInd Bank regularly. So the market reacted positively once the squeeze on the bank went away. The bank subsequently declared results which was better than what the market expected. The bank had far less losses than what the market thought it would. The banks became very conservative in lending and increased its PCR. At this high price, the bank has now said it will raise more equity capital to buffer itself. The Basel ratio for the bank has also gone up against a requirement of 8 or 9. This is in excess of 15 or 16. In my opinion, the ability to buy this bank was a no-brainer. Those who bought equity have more than made twice the return, and the guys who bought bonds, not willing to risk in equity, have also made stellar returns. They have got their interest plus more than a 25% appreciation in capital. This is why I am saying, when you know a company is solid, you could be able to swoop in and buy at that time. Howard Marks, one of the best value in distressed debt investors, famously said, no asset is worth zero. Every worth asset is fairly valued at some price. It is for us to find out what is the value at which the asset is fairly priced. So once you take over that, how do you run the bank? That's what matters. In fact, Harvard Marks made a serious bid to buy Divan Housing Finance Limited till it went to Ajay Perimal. Till the last round, they kept bidding and bidding higher and higher after studying the books of the borrower. He has also made investments in distressed debt of real estate majors in India. What triggered this discussion is the fact that I saw an article in Financial Times which said that distressed debt hedge fund managers have had a jackpot year, averaging 9.5 to 10% returns. But there is one particular fund, John Madrak Fund, which has returned 26.5%, and Vinod Koshla's Ventures Fund has returned 15.5%. You cannot compare this with equity because these funds are basically investing in distressed debt, bonds at cheap price. There are cases of people who have bought distressed asset very cheap, especially Argentinian bonds, and chased the Argentinian government all over the world till it settled at a price far higher. They bought the Argentinian debt at few cents to a dollar and settled it at 50 to 60 cents and made a large killing. But you need to have nerves of steel to play in this market because we don't know which is a good debt and which is not, and which debt will turn bad. In times of trouble like this, when the credit market squeezes like it did during the pandemic, people should swoop in and buy these distressed debt assets and wait for a year or two for the loose monetary policies unleashed by the central bankers to work its way, and then you enter into a period where there is credit nirvana. That is what exactly happened in America. It is only sad that such funds don't exist in India, which will help a lot our MSME and SME who genuinely require these kind of funds to bail them out. Thank you for watching. Be rich. It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.